So in the last lecture, we talked a little bit about how to value stocks, and we talked about this idea that much of the value of stocks came from future growth opportunities from investment projects that the firm could undertake. So in this lecture, we're going to talk a little bit about how they actually choose these projects and how they depict which ones are the best. So we want to generally say that the best way to evaluate whether an investment project is worthwhile is to use the NPV rule. So if you remember, the net present value was just going to be the present value of all of the future payoffs discounted by the appropriate number of periods. So in this case, here we have cash flows. So C0 is the cash flow in year 0. C1 is the cash flow in year 1, C2 is the cash flow in year 2, and so on. And we're discounting each cash flow by the appropriate number of periods using the discount rate R. So typically when we're talking about net present value, we're assuming that C0 is going to be negative. So C0 is some amount that we have to invest today, and then C1, C2, and so forth will be positive because these are going to be the returns that the investment generates in the future. However, a project does not have to follow this pattern. It could be very well possible that these cash flows can be whatever sign we want them to be, and we'd still be able to calculate the NPV in the same way. Now, like we talked about in the last lecture, this R, this discount rate, is not necessarily going to be the interest rate. So, and as you can see, the NPV is very sensitive to the choice of the discount rate, right? So the discount rate is going to be representing the required rate of return. And the NPV is very sensitive to the choice of discount rate. So how are we going to be able to estimate what the correct discount rate is? In order to estimate the discount rate, we have to think about what is the opportunity cost of investing in this particular project as opposed to something else, right? So once again, we need to go back to this comparison of, well, what kind of return is the company able to generate through its investment projects as opposed to what investors could find on their own, right? If you say, okay, well, instead of the company retaining the earnings and investing in the project, they're going to pay out this money to shareholders, and then shareholders are going to find the best return they can on their own. So we need to think about a comparable alternative. So typically, when we want to estimate the discount rate, we want to think about the return on another company's stock that has a similar profile, a similar kinds of risks that are faced by this company. And that's going to represent the opportunity cost of capital, which is what we're going to use for the discount rate. So we always want to think about something comparable, something with the same types of risks, because we can imagine that if the company were not investing in this project, it would be paying out its earnings to shareholders. Those shareholders would then be trying to buy shares in another company that has a similar risk profile to this company. So we're going to compare the net present value rule to some alternative metrics that you might think about using for evaluating projects. So some of these include the payback rule and the IRR rule. So IRR stands for internal rate of return. And these rules can, in many instances, be a little bit more intuitive, a little bit easier for the typical person to grasp the net present value. Net present value doesn't really have a lot of meaning to people. However, the NPV rule has a couple of advantages. One is that it recognizes the time value of money. We'll talk about how the payback rule and the IR rule work in a little bit. But the payback rule especially does not properly discount payoffs that come in the future. And the NPV rule is also useful because we're only considering cash flows. We're not thinking about how things are being recorded. So whether something is being recorded as a profit or not is not important to us. What we really care about is when money is coming in and when money is going out. Everything else is window dressing. And the NPV rule is also nice because it doesn't change when projects are bundled together. So if I have one project that has an NPV of NPV1, and then I have another project with an NPV of NPV2, if I want to combine these two, NPV is just additive. Whereas, for example, if I'm trying to measure the rate of return, sometimes I can try to goose the numbers a little bit by bundling a low return project with a high return project to make the overall return seem higher. That doesn't change the fact that the low return project is not really worth doing, and we should just do the high return project on its own. With NPV, there's not so much confusion just because it's additive. So let's think about some alternatives to NPV. One of the simplest ones we can think about is the payback period. So the payback period, I think, is the first thing that people will generally think about when they evaluate whether a particular investment opportunity is worthwhile. And it's a very simple question. How long is it going to take before this investment pays for itself? Okay. So we want to think about how long it's going to take before the cumulative cash flow equals the initial investment. So for example, if I had a project where I had to, say, invest $100 today, and I was making, say, $35 every year, then it would take 3 years for me to break even. So when I'm using the payback rule, I just apply a metric where I say, okay, well, anything that pays back within a certain number of years, I accept. If it doesn't pay back within a certain number of years, then I reject it. Now, payback period is very simple, very intuitive, very easy for us to understand, and easy to explain to other people. However, the payback period has a number of major pitfalls. First one is that I'm treating all of the payoffs equally. Now, you can see here that with this project, yes, I'm breaking even after 3 years, but that's only if I count all of these cash flows equally. But I know that the cash flows that come in the future should be discounted, right? The 35 in year 1 is not worth $35 today. So if I'm discounting, yes, after 3 years I have supposedly broken even, but using any discount rate that's slightly above 0, you can see that my NPV is still going to be negative after 3 years. I'm not really going to be breaking even in present value terms until afterwards. And the other pitfall with payback period is that it completely ignores any cash flows beyond the break-even point, right? So when I'm evaluating a project, I don't want to the goal is not to break even, right? The goal is to generate as much value as possible. So if I'm fixating on just making back what I put in initially, I may be ignoring projects, particularly ones with long time horizons that don't break even as quickly, but can potentially generate a lot more value in the long term. So let's think about a couple of different investment projects. Project A, I pay $2,000 today and I get 500, 500. B, well, they all cost $2,000 today. I get 500 and then 1,800. Project C, again, 2,000 today, 1,800 and then 500. And let's imagine that I set a cutoff of 2 years. So any project that pays me back within 2 years, I accept. If it doesn't pay me back within 2 years, I reject. Sorry. Okay, so if I apply that cutoff rule, that means I'm going to reject A, I'm going to accept B, and I'm going to accept C. Is that smart? Well, clearly not, because if I look at project A, I get this huge payoff in year 3, but the payback period completely ignores it. In fact, if I compute the NPV of each of these with R equals 10%, the NPV of A is the highest. It's over 2,600, whereas the NPV of B is actually negative, and the NPV of C is only slightly positive. And then furthermore, from the perspective of the payoff period, the payback period, B and C are the same because they both pay me back within 2 years, but I can see that clearly project C is better than project B because I get paid more earlier. So the net present value will be higher. Payback period will ignore both of these, and it will lead me to believe that to invest in projects that I don't want to invest in and ignore projects that I want to invest in. So let's think about another alternative to NPV, which is the internal rate of return rule. So let's imagine I had a project where I have to pay $100 today and I get paid $110 in the future. Very easy to figure out what the rate of return on this is. The rate of return on this is going to be 10%. Or I can write this as the net present value is C0 plus C1 divided by 1 plus R. And if I let R equals 10%, if I let the discount rate equal the actual rate of return of this project, the NPV is going to be 0. So that's how I'm going to define the internal rate of return. The internal rate of return for any project. So if I want to write something more generally, the internal rate of return is going to be the discount rate that solves for NPV equals 0. So if I use the internal rate of return as a discount rate for the sequence of cash flows in this project, I'm going to get an NPV of 0. So let's say I have a project where the cash flows are minus 4,000, 2,000, and then 4,000. I am going to calculate the internal rate of return by writing out the net present value and solving for what discount rate makes this expression equal to 0, which in this case will give me an internal rate of return of about 28%. So if I get an internal rate of return of 28%, that then tells me, well, I can compare the rate of return on this project with the discount rate that investors require, and that will tell me whether I want to do the project or not. So if R is equal to 0, so I have a discount rate that's lower than the rate of return, then the NPV is going to be positive, and I want to invest in this project. If I have a discount rate that's higher than the internal rate of return, the NPV is going to be negative. Why? Because you can see that the NPV for a project where I have to pay money now and I get payoffs in the future is typically going to be declining in the discount rate. So the more that I discount the future payoffs, the less that the NPV will be. So if I find the point at which the NPV crosses 0, this tells me the rate of return I earn on this project. And if the required rate of return is lower, that means the project is generating extra returns and it's something I should do. If the required rate of return is higher than the IRR, then this project is not generating enough of a return and I should not do it. So what I can see from this picture, right, what we can see from this picture is that if I graph the NPV against the discount rate, it's going to be a decreasing function, and it's going to cross 0 at the internal rate of return, and I should accept the project if the discount rate is lower than this and reject it if the discount rate is higher. So the internal rate of return rule is very easy to interpret, right? I have a threshold that tells me, okay, I have a required rate of return that my investors require. So any project that I can come up with that has a higher return than this, I should do. Anything that doesn't have a high enough return, I shouldn't do. And this is much easier to interpret than NPV, right? It's a lot easier for us to wrap our heads around the idea of the rate of return on an investment project compared to the NPV, which represents the amount of extra value that the project can generate. So it's a lot easier for us to understand, a lot easier for us to comprehend. The NPV is also going to be a lot more sensitive to our estimate of the discount rate. So for example, if I had an estimate of the discount rate as being, say, 10%, and I calculate the IRR was, say, 15%, well, the fact that the discount rate is a rough estimate is not a big deal, because I say, well, even if I'm off by a couple percentage points here, the IRR is high enough. The IRR is high enough such that even if the actual discount rate was a little bit higher than this, then I'm still more than likely going to end up with a worthwhile project. If I were to apply the NPV rule here, I would really have to be a lot more careful with what my estimated discount rate is. If I'm off by a little bit, then my NPV calculation can be off by a lot. When we're talking about the IRR rule, the advantage is that it's a little bit easier for us to interpret than NPV, and it also gives us a little bit of leeway to estimate the discount rate. However, the IRR rule has a lot of pitfalls of its own that make it more confusing to use in a lot of different circumstances. So typically, we're thinking about investment projects, right? We're thinking about projects where you pay today and you get paid later. Right? A project like this is going to have an IRR of 50%, 0.5. And this is going to have an NPV, if I let R is equal to 0.1, of 364. If I look at a project like B, though, where I am having a borrowing project, that means I get money today and I have to pay it back later, the IRR is the same, but the NPV, of course, is going to be negative here. And so when I apply the NPV rule, I don't really need to think about what type of project it is. I don't need to think about the signs of these payoffs other than the fact of how they enter into the NPV formula. However, when I use the IRR rule, I need to think about, well, first off, is this a borrowing or a lending project? For a project like A, which is a lending project, I want a high rate of return, right? I want to lend at a high rate. But for a borrowing project like B, I want to borrow at a low rate. So the IRR rule is going to flip here. Whatever threshold I set, for a lending project, I want the rate of return to be higher than the discount rate. And for a borrowing project, I want the rate of return to be lower than the discount rate. So before I compute the IRR and apply the rule, I need to think about what it is first, whether it's a borrowing project or a lending project. This is not something I have to worry about with the NPV rule, because the NPV rule says if it's NPV greater than 0, then I accept it. NPV less than 0, reject it, regardless of how the payoffs are structured. There's also an issue when I have a project where the payoffs are not clearly structured as a borrowing or a lending project. For example, let's imagine I have a project where I have to pay 30 today and I get payoffs of 10 between years 1 and 9, but then in year 10, I have to pay 65. So I have a negative payoff at the beginning, at the end, and positive payoffs in the middle. If I wanted to solve for the IRR, I would need to solve this polynomial. And we know that with polynomials, this is a 10th degree polynomial, it can have multiple zeros. In this case, I'm going to have two solutions. The IRR can either be 3% or it can be minus 19%. Both of these would satisfy this equation. So both of these are valid internal rates of return. Which means that if I'm going to apply the IRR rule, saying, okay, I'm going to accept that the IRR exceeds a certain threshold or not, then I may not be able to answer the question because I could have multiple rates of return. So if I look at this picture, what we can see is that while for an investment project, the NPV is always going to be decreasing in R, and therefore I have a single zero. For a more general cash flow structure, I could have multiple zeros. In this case, I would have two internal rates of return, and if the discount rate managed to fall between these two, then I would not be able to decide whether to do the project using the IRR rule. So with a polynomial, I can either have one solution, I could have multiple solutions, or I could have no solutions. So I could have a case where I have multiple IRRs, and I could have a case where the IRR is undefined. In either of these last two cases, applying the IRR rule is going to be impossible. So another instance in which it may be advantageous to think about the NPV rule versus the IRR rule is when we're choosing between multiple mutually exclusive projects. So far we've been thinking about project analysis in the sense of each project is evaluated independently. Whether or not I do a project has no bearing on whether I do anything else. So I'm not choosing between options that are mutually exclusive. But if that is the case, then there's a couple of different things I have to consider that make the IRR rule less effective. Let's look at this example. I have projects D and E. Project D costs $10,000 today, and I get $20,000 a year from now. And then project E costs $20,000, and I get $35,000 a year from now. So if I compute the internal rate of return, project D has an internal rate of return of 100%. E has a return of 75%. So it would appear, going by that metric, that project D is better because it has a higher rate of return. But if I let the discount rate be 10% and I compute the net present value, what I see is that project E is going to have a higher net present value than project D. And it's fairly obvious from looking at this because project E is bigger, right? It requires a bigger initial investment. And even though the return is smaller in percentage terms, in terms of the value that it generates, project E is going to be better. Now, if it were the case that I could make these decisions independently, I would choose to do both because they both have a positive NPV. But if I have to choose between the two, I want to choose the one that has a higher NPV over the one that has a higher internal rate of return. And it's not always just a matter of scale. So let's look at another example. Project F takes $9,000 initially, then I get 6, 5, and 4 for the next 3 years, and nothing after that. This is going to have an internal rate of return of 33%, and at a 10% discount rate, the NPV will be about $3,600. Whereas project G is going to cost the same initially, but it's going to give me $1,800 every year in perpetuity. This will have a lower IRR, but the NPV will be higher. And why is that the case? Well, because if you look here, the internal rate of return is much higher than the discount rate of 10%, which means that for a longer term project like Project G, the payoffs that come far in the future are going to contribute a lot more. So that even though these projects are of the same scale and Project F has a higher internal rate of return, because Project G has such a longer lifespan, the NPV will be higher. So if I'm forced to choose between F and G, I want to choose G and not F. Another issue that we might run into trying to apply the internal rate of return rule is that there may not be a single discount rate that we can compare it against. So if you remember, when we were talking about pricing bonds, we could have different spot rates for different periods of time. And in general, we can have different discount rates for different maturities. So I have R1 here and R2 here. And I could have different discount rates for each period of time. So in this case, if I were trying to evaluate this project, and for example, the internal rate of return was less than R1 but greater than R2, now I don't have a single benchmark to compare the IRR against, so I wouldn't be able to make a decision here. Now, it might seem we're kind of belaboring the point by fixating so much on internal rate of return and why we shouldn't use it and why NPV is better. But it remains the fact that IRR is a lot more popular because, well, it's simpler to understand, right? It's a lot easier for us to comprehend the rate of return on an investment as opposed to thinking about how much excess value it generates. And NPV, while it works very well, if we have a good estimate for the discount rate, if we're kind of shaky about about how good our estimate of the discount rate is, then we could be off by a lot, and it might seem safer to just use IRR. So, however, because of the different examples we've looked at, the IRR rule also has a bunch of different pitfalls. So generally speaking, it's best for us to try to obtain the best estimate of the discount rate, multiple ones if need be, and to compute the NPV and make the decision that way. It's going to have fewer obstacles to getting a good answer than using the IRR rule. So let's think about how we would actually apply the NPV rule in practice to do project analysis. The first thing we need to pay attention to is that we want to focus on cash flows and not profits. So the distinction here is that profits exist on a balance sheet. They incorporate things like depreciation, which are not actual cash flow. So let's think about how this would work. Okay, let's imagine that I have a project that requires an initial capital expense of, say, $12,000. And if I were computing the NPV, I want to count this entire expense in year 0 because, of course, that's when the cash flow actually happens. But what an accountant might do, well, I don't really want to count this entire expense in year 0. For tax purposes, it's probably better if I depreciate this, say, over the next 6 years. So I'm going to count $2,000 worth of depreciation over the next 6 years. This will generally be better for tax purposes, but when I think about depreciation, depreciation is not a cash flow. There's no money actually leaving my hands here, right? All the money was spent in year 0. Therefore, if I'm doing an honest NPV analysis, I want to count this entire expense in year 0. I don't want to treat depreciation as a cash flow. Another thing I need to be careful about is that I only need to worry about incremental cash flows. I don't need to think about sunk costs. So you may have heard the saying that you never throw good money after bad. So for example, let's imagine I have an investment in a factory and I have determined that this factory is a loser. There's no way I'm ever going to make my money back. That this investment in the factory is a negative NPV venture. And I have an opportunity to do some renovations on the factory that are going to improve the amount of revenue it generates, but only up to a point. So if I consider the renovation project on its own, then the NPV is positive. But if I consider the overall factory, including the renovation, it's still going to be negative. So in that case, do I want to do the renovation or not? Well, if I think about the initial expense on the factory, well, that's a sunk cost, right? I'm not getting that money back no matter what I do. So even though the entire project is a loser, the incremental cash flows from doing the renovation are positive by themselves. Therefore, the renovation is a worthwhile project because I'm considering it on its own. I can forget the fact that the entire project is a loser because that money has already been spent. Another thing I need to watch out for is that I need to be consistent in my treatment of inflation. So I can compute NPV in nominal terms, so in money terms, in which case I want to use R nominal, which is the nominal discount rate. Or I can have the cash flows expressed in real terms, in terms of purchasing power, in which case I would want to use the real discount rate. Now, I can approximate the real discount rate by subtracting the rate of inflation from the nominal discount rate, but to be more precise, I want to do 1 plus R nominal divided by 1 plus the inflation rate minus 1. So I can do everything using real values, or I can do everything using nominal values. Either approach is legitimate. What I shouldn't do, though, is I shouldn't mix the two. I need to make sure that if I'm computing NPV using nominal values, I use the nominal cash flows and the nominal discount rate. If I'm doing it with real values, I want the real cash flows and the real discount rate. So when do I want to use either approach? Nominal values are useful if I'm thinking about cash flows that aren't going to move up and down with the price level. So for example, if I'm paying back a loan and I know the nominal interest rate, well, the amount that I have to pay back is not going to change depending on the overall price level in the economy. On the other hand, if I have cash flows that, for example, represent sales of goods, I can imagine that the revenues that I'm able to earn are going to vary with the price level. So in that case, it might be better to use the real cash flows and use the real discount rate. Another thing that I need to watch out for, I need to make sure I separate investment and financing decisions. So what this means is that whether or not I should do a project should be decided separately from how I want to pay for it. So I want to assume that I can finance every project using all equity and compute the NPV that way. And if it's a positive NPV project, then I decide whether or not I should finance it with equity or finance it using debt or financing it using retained earnings. So I separate the investment decision from the financing decision. How I pay for a project should not influence whether or not I do it. Now, there's a caveat to all this, which is that I need to account for taxes. So all cash flows should be estimated on an after-tax basis. And this changes a couple of things we said before. So we talked about the fact that depreciation is not a cash flow. If I have a capital expenditure and I'm depreciating it over the life of the project, I should not treat those depreciation expenses as cash flows. However, depreciation does matter for tax purposes. Depreciation creates a tax shield, which reduces the tax I have to pay. And while depreciation itself is not a cash flow, the tax shield does represent a cash flow. So while I don't want to include the depreciation expense itself in my NPV calculation, the tax effects should be included. We also talked about how you should separate investment and financing decisions, that it shouldn't matter how you finance a project. However, if I finance a project with debt, that creates an interest tax shield, whereas there's no equivalent thing if I finance it with equity. Once again, the tax effects need to be counted because they do represent an actual cash flow, regardless of whether the actual thing I'm considering alters my cash flows or not. So it may be a little bit difficult to read this table, but what you can see here is that there's an initial capital expenditure that's being depreciated over the life of the project. The depreciation expense is used to calculate the pre-tax profit, and then after applying the tax rate, we can see that the depreciation expenditure creates a tax shield, which reduces the amount of tax we have to pay. The depreciation itself is not a cash flow, but the tax shield is a cash flow. So if you look at the bottom couple rows where we're calculating the net present value, we do need to include the effect of the depreciation tax shield, even if the depreciation expense itself is not being included. There's a couple other things that we can do with the NPV rule as well. One decision that we might have to consider from time to time is when to harvest a particular asset. So let's imagine we have an asset that's worth 50 today, but the longer we wait, the more it's going to be worth. So it's going to gain value over time. Now, the longer we delay, the more it's going to be worth, but of course, also, the further in the future the payoff is going to be. So if we compute the NPV, we can discount these future values. And we can see that the best time to harvest is when the NPV is maximized. So that gives us the optimal trade-off between this asset appreciating in value and the fact that payoffs in the future are going to be discounted. Another thing we can do with NPVs is to analyze the decision between long and short-lived equipment. So if you look here, we have two machines, A and B. So A has an initial cost of 15, and then it lasts for 3 years, so you need to pay 5 for the next 3 years to maintain it. If I let the discount rate be 6%, the present value of all these costs is going to be 28.37. Machine B is going to cost 10 today, but only lasts for 2 years. The maintenance costs are 6. The present value is 21. Now, we need to think about, well, A is more costly, but it doesn't need to be replaced as often. Therefore, it may be better to actually buy machine A over machine B. Now, we need to adjust for the fact that machine A lasts longer, but what we don't want to do is simply divide the present value of A by 3 and divide the present value of B by 2. This is not the way to do it, all right? Why? Because once again, we want to make sure we take into account the time value of money, and simply treating cash flows that arrive at different times as if they're equivalent is not the way to do it. So if we're not supposed to just divide the present value by the life of the machine, how are we supposed to do it? Well, if A lasts for 3 years, let's compute what's called the equivalent annual cost. Now, the cost of A is not spread evenly across 3 years, but let's imagine that it was. let's fix the present value to be the same as the actual present value. And let's say, how big of a 3-year annuity would I have to have the same present value as the cost of A? So I use the annuity formula with t equals 3. And I set that equal to the present value of A. That gives me an equivalent annual cost of 10.61. If I do the same thing for B, well, B is a 2-year machine. So I use a 2-year annuity with the same present value as B, which is 21. And that gives me an equivalent annual cost for B of 11.45. So it's a little bit more complicated than just dividing the present value by the life of the machine, but it's going to give me a better answer, right? Because I can say, well, if I'm buying machine A, essentially what I'm doing is I'm paying EAC every year in perpetuity, right? Because I'm paying EAC for 3 years every time I replace the machine. So after 3 years, I replace the machine and I have these 3 same cash flows again. So if I just replace machine A every 3 years, that's the same as paying EAC-A in perpetuity. And if I replace machine B every 2 years, that's like paying EAC-B in perpetuity. So when I try to decide which machine I should choose, I just pick the one with the lower equivalent annual cost, which is machine A. We can generalize the idea of equivalent annual cost to just talk about equivalent annual cash flows. So for example, let's imagine I have an old machine that's generating cash flows of 4 per year, and this machine can last for the next 2 years. And I have a new machine that's going to cost me 15 today, and it's going to generate cash flows of 8 for the next 3 years. The net present value of this thing is going to be 6.38. And if I apply the same logic, I calculate the equivalent annual cash flow now, because now I have both negative and positive values. The equivalent annual cash flow is going to be 2.387 for the next 3 years. So what does this tell me? Well, even though this new machine is going to double the revenue that I can generate, if I incorporate the costs, it has an equivalent annual cash flow that's less than that of the old machine. That means that the best time to replace the old machine is only when I have to, right? Because 2.387 is less than 4, so I should wait until year 3 to replace the machine, because at that point I'm forced to. So this is how we would use equivalent annual cash flow to decide when to replace an old asset.